Now we talk about the employer-provided retirement pensions. So these are the pension plans which companies provide their employees. They are for retirement purpose, investments, and in most cases, both the employee and the employer, they will contribute to it. One type is called a defined benefit plan. Here, the pension is known. In the defined benefit plan, it doesn't matter how much money is contributed. There is a fixed pension that the employee can get. They could get more if they contribute also, but the pension is known based on the formula, usually depending on how long they work with the company and their salary. It could be a flat benefit. Here, it could be a fixed amount for everybody the same if it's a unionized company, or it could be an average of their income over the duration of their work at the company, or it could be a final average in the last 5 or 10 years they work with the company. Then they could have the calculation based on that. There are also individual pension plans for directors, senior level people who are earning higher amount of money. They can set up a separate IPP plan for them also. This is also a type of defined benefit plan. Then there's deferred profit sharing plan. In the deferred profit sharing plan, the company will put money only when they make a profit. Then there are pool registered pension plans, group RSPs, and defined contribution. So defined contribution is similar to the defined benefit, but in the defined contribution, the benefit is unknown. We don't know how much they will get in pension, but it depends on the returns from the investment. So the employee has to make the decision about investments. So it depends on the investment growth. So let's talk about these in more detail. The defined benefit plan, for this one, all full-time employees are usually eligible. After 2 years, they can join the defined benefit plan. Part-time can also join, usually after some time period if they meet certain criteria, such as 700 hours of work. So contributions, employer must contribute. Actually, employer has to contribute in all of these. They have to put money in. If the employee also contributes, then it is called a contributory plan. And in this case, the employee will get a higher pension in retirement based on this. If the employee does not contribute, it's called a non-contributory plan. So in this defined benefit plan, the member makes no decision making. They will get a fixed pension based on their situation. So as we mentioned, the payment can be either average of the career earnings, average of the final earnings, or a flat benefit. So what is the benefit of these? In the flat benefit, it's usually it increases as the result of ongoing employer-employee negotiation. So usually they will be going up, and the formula easy to understand. It's the same for everybody, and it is paid in addition to old age security and CPP benefits. The disadvantage is that it doesn't matter how much you're earning, and the pension plan must be negotiated to keep it growing at least with inflation. If inflation is 2, 3, 4%, we would want the pension plan to increase also at that rate. In the career average, these are based on the income of the person over the time they work with the company. And so they're easily integrated with CPP and QPP. They give equal weightage to the employee's earnings throughout their career. And many companies update the career average plan by updating the base year. For example, if the base year is moved forward to 2018, all service prior to 2018 will be based on 2018 earnings instead of the actual salary. The disadvantages of this is that it is similar to the flat benefit plan. The pension payable at retirement may be decreased by inflation if the percentage is not increased regularly. For the final Average ones, again, this is providing a pension based on earnings near retirement. So usually people will be earning more at the final years with the company, but it's possible due to health or other reasons, if the person decreases their income goes down in the final years, then this will not be advantageous. Pool registered pension plans. These were proposed in 2011 by the federal government, and they have been initiated. So it is for small employers. The pension is pooled across the sponsor to save the cost. It can be self-directed, meaning the employees may make their own decisions about the investment, and the contribution limits are similar to other pension plans and RSPs. So it could be, it's good for employees or firms with no pension. And it's good also for self-employed people. Defined contribution plan is the second type. So in here, there's a fixed percentage that the employees will put into this, to the plan. The benefit depends on whatever the cumulative value will provide. So the employee takes the investment risk in this. They could earn more, they could earn less, depends on the situation of the investments. The maximum annual contribution is lesser of the two, 18% of the employee's compensation. So if the employee's compensation is $100,000 annual, then $18,000 is the maximum they can put in, or up to the limit for the year. For example, in 2013, it was $24,270, and it goes up every year. The maximum annual contribution becomes the pension adjustment. So whatever you put into this defined contribution plan, it will reduce your RSP limit dollar for dollar. So in here, we said the pension is unknown. It depends on the performance. And on retirement, the pension funds are transferred to a LIRA account and then a LIF account or annuity. It pays a percentage, usually 60%, to the spouse if the person dies, or the committed value is paid to a beneficiary. And like most pension plans, the defined contribution plan payments are taxed. So next we talk about retirement savings plans, which are, for example, RRSP. So this is the next section that we will discuss about.